Hello, everyone. Today on the final bar, we will wrap the week to our normal Friday routine of looking at how the markets have evolved Friday close to Friday close. What are the key movements in the key charts we want to pay attention to? The S&P really once again in digestion mode. That's the way I describe a market that's had a big rally or a big sell-off and then sort of consolidates a little bit, sort of makes peace with its recent move, digests it, gets ready to make the next step. And which way will that be? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets using the power of data visualization, the power of charts, the power of using the price action to quantify investor psychology, investor sentiment, fear, greed, euphoria, desperation, all of those emotions which reflect themselves in or manifest themselves in price action. As I mentioned, the S&P selling off a bit going into the close in the last half hour or so, and overall it sort of backs up what we saw yesterday. There's sort of a digestion way of ending the last Thursday and Friday, wrapping the week here. Defensive sectors leading the way a little bit today, and some of the groups that have gotten us much of the way here over the holidays: financials, energy, industrials, materials, at the bottom of the return list. So, the question we talked about, my guest yesterday was talking about, this movement in, away from some of those value-oriented spaces back into the high beta stuff, but back into the growth story. Let's see what the charts can tell us about that potentially playing out. Now, we have some great guests on this show, and I'm super thankful having guys like Sam Burns and others that we had this week, who I just think are really thoughtful, knowledgeable, and bring a lot to the table. Joe Rabel as well comes to mind. Next week, more of the same. So on Tuesday, we have Bruce Powers. Bruce is a longtime technical analyst. I've known him for a number of years, and he was based in Dubai for a number of years. So I've always valued his perspective, which is different than mine and others. On Wednesday, we have Julius DeKempener, founder of RRG Research, host of Sector Spotlight, talking to us about rotation, and a perfect time to have Julius on, thinking about this rotation around growth and value and what may be coming next. And then on Thursday, Danielle Shea always brings a couple options ideas with us, with her. So I'll be very interested to get her take on this overall environment. We've talked about getting to our market recap. We've talked about what sort of environment we would see, and sort of my base case that I talked about toward the end of last year, beginning of this year, was a pullback in January and February, thinking of 2010, sort of after the 2009 low, the big rally. Then 2010 finished the year positive, but it was choppy, and you hit some swing lows along the way. I sort of thought of that as a good analog for what I could see this year, 2021, becoming. We haven't had it yet. We've just had strength. So one of our poll questions recently: which of these is most likely to happen before March 31st, 2021, which is just over 2 months away now? Choice 1, the S&P breaks above 4,200. Choice 2, the S&P breaks below 3,200. Choice 3, Bitcoin breaks above 50,000. Choice 4, Bitcoin breaks below 24,000. I struggled a little bit as I was crafting that question because things that seem ridiculous, objectives that seem completely outlandish for Bitcoin, seem to get reached in a day or two. So I wanted to make sure we moved the goalposts out just a little bit. A lot of, a good spread of responses, but 41% of you, just under half, said the S&P breaking above 4,200. So, sort of the way I would interpret the collective outlook for the group is we see stocks, appreciating the most in terms of stocks' ability to maintain this uptrend that has gotten us to this point. Less likely that you would see a huge move in Bitcoin. Now, again, that's a range of 50,000 to 24,000 that Bitcoin can remain in. Those are career-busting percent changes along the way there. But what's interesting to me is only 20% thought the S&P breaking below 3,200 would seem likely. And for me, that being one of the least likely, the ones that people are voting on the least, are big breakdowns in assets, which makes me, of course, start to think how would that actually look? How would I trade or invest around that scenario? So again, hopefully what that helped you do, if you answer that question, or if you're looking at the results now, it's not about predicting the future. That is not what this game is about. It's about understanding potential outcomes, and think about each one of those four scenarios. What would you do if Bitcoin goes above 50,000 up to 100,000? At what point would you think maybe it's time to participate? If you do own Bitcoin, what between now and 24,000, where would you decide you need to unwind some of that risk? And that's the way I would think about long-term investing. Think of scenarios, think of probabilities, and think about what you would do in those different potential outcomes. Continuing on here with our wrap of the week segment. So the goal here on Friday, as always, is to just look at how the markets have evolved Friday to Friday. So we're going to start with a weekly change here. The labels have tweaked around a little bit because we had some movement going into the close. The S&P selling off a bit. So I'm going to prettify this chart just a touch. That's good enough. And let's look at what has evolved. So overall, the S&P 500 there in black, finishing the week about just over 1% up from last Friday. And these might move around just a little bit as we're, digesting the closing prices, getting all the data lined up, but it's going to be about where it settles in. What outperformed the U.S. Equity market in the form of the S&P? Not much. Emerging markets just above there, about 1.25% up. The Nasdaq led the way higher, up 3.5%. And we're going to see in a little bit the return of the fan mag trade, the Fang Man, the Fang, whatever you would call that group, the MAGA trade. I've heard it called. It just depends on how you want to. What mix of acronyms you want to create, but essentially there's certainly a leaning back into the growth trade, back into the mega cap tech consumer communication services trade. We're going to look at some of those charts that certainly suggest further upside potential there. What underperformed stocks are pretty much everything else. Small caps underperformed. They were still up about 0.5%, but not much. Bonds pretty much the same as that, up about 0.4%. That's the TLT that we're looking at. Gold, we're using the GLD. That was up just under 0.4%. The US dollar essentially flat for the week. And then what was the big weakening movement was crude oil, down 2.8%. I did not put Bitcoin. That's actually down here, down probably 10-15%. We'll see how the day actually ended, but overall certainly would have skewed the entire chart to the downside. So I eliminated it from here just for visibility. But that's how things did. So overall, stocks sort of led the way, and the Nasdaq, sort of that big mega cap tech trade, communication services trade, was certainly the winner from last Friday to this Friday. That's a bit of a change of character because up until this week, we've been talking all about financials and energy and industrials and materials and sort of the infrastructure trade, the rise in crude oil, the rise in interest rates. There's a bit of a pause here. And I think the question we're all going to have to answer now is, which market are we going to see going forward? Is it a resumption of this uptrend in financials? If that's what you're thinking, you better be expecting higher rates because that's what's driving the outperformance of the financial sector. Is a continued up move in crude oil, which would probably be an against the consensus kind of call. I think the general consensus is at some point crude oil seems like you're gonna, it's not able to justify that sort of price. You come off a little bit. That's going to hurt energy stocks. That's what we're seeing this week. My guest yesterday, Sam Burns, was certainly in that latter camp, thinking that that enough is enough. We see sort of a breather in the financials, energy trade, and a reemergence of big tech and consumers. Certainly, we're seeing that so far this week. Let's continue on our discussion using the Mindful Investor Live chart list. As always, as a reminder, if you've not seen this list before, this is a list that I create and maintain. We use it pretty regularly on the show, but absolutely every Friday. If you've not used this before, at the top of StockCharts, go to the Articles tab. Up here in the upper right, this will give you all the different blogs on our platform, sort of the home pages for each expert. Mine is called The Mindful Investor, and at the very top of that, you're going to see a link for the live chart list. Just click on that, and you'll get to this page that we're looking at. So we start with the market trend, and this is driven off of weekly data. For me, models are not an output of the process. I don't use models as a trading system or use them as a way to automate anything. I use them as an input. So I like to have a trend following model that sort of runs in the background. That gives me something, systematic that tells me the overall bias with which I should be looking at market activity. And what we're seeing, looking at weekly exponential moving averages, and I have it in 3 timeframes: long-term, medium-term, short-term, all positive. And you can see it's based on the difference between these moving averages, the 21 and 34 week exponential averages here at the bottom. The 5-week exponential average is the short-term indicator. All of these are positive. You have the price above all of these upward sloping moving averages. So, all of them have been positive for a stretch here. The long-term model turned positive in June. The medium-term model turned positive in May. It did have a head fake there in October of last year, turned back positive at the beginning of November, and has remained positive since then. That was during this sort of congestion zone there in October, November. The short-term model was negative last in October and turned positive at the end of the month as we bounced off of those moving averages and has remained positive since then. And again, this is why I use a model like this. There have been a couple times where the markets come off a little bit and I thought, boy, this could be the beginning of something else. But this is a reminder, until you break that, until you break the 5-week exponential moving average, you can't go any lower than that, right? So, I mean, the trend by definition remaining relatively constructive there. Second chart, focusing a little bit more on the daily activity. As we've talked about on the show in recent weeks, I think this trend line taking the lows from October, which was the end of this sort of, think of the run out of the, the March low, you have the consolidation in April, the move higher into the June peak, and then the subsequent August to September peak. Then you had this 2-month period of consolidation of lower highs, higher lows, and then we broke out to the upside. And that's this green shaded area. I think that's a pretty compelling reversal zone. So if and when we would break trend line support, I'd be looking at two things. First, the 50-day moving average, which is currently around 3,700. Second would be this green shaded area, which is a level of a level where the market has some memory. This is where it spent some time before the resistance level became a support level. And that's where I would look for some additional support right there. So if you think about it, the market could go down another 200, 250 points and still be within the context of a longer term upturn. You think about these pullbacks in September and October, felt severe at the time, but overall you can see it was just sort of the natural trajectory of this uptrend. And so I think, there's plenty of room for this market to pull back, I think, as we go from January into February. And again, I still see it as very likely, given the euphoric sentiment readings that we're seeing right now. I wouldn't be surprised if we get some sort of pullback, which will shake some people out and then set the stage for further upside. Breadth readings by pretty much any measure remain pretty constructive. I don't think I have, oh, I do actually, so I won't jump the gun. The cumulative advanced decline lines remain very positive. These are very subjectively color coded by me, green, amber, or red, depending on what I see them. Stoplight style, bullish, neutral, or bearish. I see these as bearish, having broken to new highs and not really looking back. The first warning signal, the early warning signal you have at the later stages of a bull market phase is when you'll get a lack of confirmation where the price is making new highs, but the cumulative advanced decline lines are not making new highs. And we're not seeing that yet. So overall, I think that remains pretty constructive. I'm stretching to call this a negative sign, so I won't do it, but I will tell you one data point to note is the decreasing number of new highs. So we're still seeing net new highs. We're still seeing a minimal 0 or 1 or 2 stocks at the most any day that are doing a new 52-week low. It's very rare. Overall, you're essentially seeing new highs consistently, but it's less and less stocks making new highs. You can see the big influx of names that you made new highs. About 22% of the S&P that made a new high when the S&P pushed higher after the holidays. Since then, it's been a consistently less number, so still positive. So yesterday, or this was Wednesday, 100 stocks, that's 10% of the S&P, made a new 52-week high. So that's not a nothing. I mean, that's something. But I have to notice that there are less and less. I don't see that as a huge negative. I see that as probably a normal cyclical pattern to an upswing, but keep an eye on that and see if that continues to play out. One potential note, and again, this is like coming up, someone did really well in a performance review and you're struggling to find some constructive feedback. This is what I'm doing when I'm looking at the S&P going higher and I'm trying to find something that would refute it. And don't get me wrong, I think the value of technical analysis is to challenge your thesis. Look at the weight of the evidence. But, I have often enjoyed doing a bull bear debate and having to take the bearish side. Give me the bearish argument on stocks. Why should they go down? So in that effort, in trying to understand what could cause more of a bearish move, one thing that I'm seeing is the percent of stocks above their 50-day moving average just starting to roll over a little bit. It's not going to new highs in the last couple of weeks. You can see price going to higher highs. You can see this indicator actually making lower peaks. And what that tells you is similar to the new highs list, right? It's not telling you that things are bad. It's just they're less good. There are less stocks really pushing to the upward trajectory. This shows you some stocks are breaking below their 50-day moving average. It's still not many and still 3 out of 4 stocks above their 50-day. So don't get me wrong. This is not a net negative. It's just less positive. And that's where you start to see some concerning signals before they materialize. Continuing on, the AAII survey had some issues with their data this week. We've gone back and forth with them. I know a number of my peers have as well. They showed some different numbers and changed them. We haven't gotten an updated value for last week, so we're just assuming a similar level at StockCharts. We'll see. We'll update that, obviously, if we get any further color. But we basically have decreased now. We've net decreased over the last couple of weeks. It looked like we had a spike higher last week. I don't think that was necessarily accurate. So what we're seeing is a decrease in bullish sentiment. It was actually net positive, in my opinion, because this tends to be a contrary signal. And if you have a huge upswing in sentiment, that usually means the later stages. The concern is, are we doing something like we did here in 2018? January 2018, the market went higher. The percent of bullish readings went lower, and that was sort of the end of that move as some people started to not believe in the uptrend anymore. Are we seeing that same sort of pattern? That's what I would be looking for. We haven't seen it in price yet, though. I don't have the name exposure index on here, but I'd love to go there very quickly, just because it was a pretty significant swing here. This is the name exposure index. As you can see, I didn't update the horizontal line, but we had 112, almost 113% long, because you can actually say you're double long, you're 200% long in this survey of active money managers. This is literally the highest reading we've ever had. I didn't refresh this chart because we had a little bit of a data problem a little back, which we've cleared up here. The highest reading ever was in December of 2017. This is now the second highest reading in the history going back to the mid 2000s. So this is truly an extreme level. The one other time it's gotten this high was at the later stages of that 2017 bull market phase. So again, when I'm thinking of what could be the guidepost, these warning signs that tell us the market might be peaking out, those are a couple of things. Breadth that potentially is not confirming and just in a limited way, and then extremes in sentiment, like we're seeing here with the name exposure index. Other than that, again, the trend is positive until proven otherwise, and I would encourage you to remember that. Other than that, lots of ratio charts and others we don't necessarily have time for. I would encourage you to spend some time with the Mindful Investor Live chart list. After this, it gets into a lot of other really good comparison charts to understand the trajectory of stocks versus other asset classes and also groups versus groups. So check those out for sure. We need to take a quick break. Back with the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday after the close as we look at these markets together using the power of data visualization, the power of stock charts. As a reminder, we're going to do another mailbag segment here in a moment, and we would love to answer one of your questions in our next mailbag session, which will be Tuesday of next week. Shoot us an email with any questions that come up, questions on particular charts, on particular tickers, on indicators, market history, market dynamics, investor psychology, whatever it is. We'll do our best to point you in the right direction. Our email is thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at finalbarsctv. On our YouTube channel, just put a comment right below the video that you're watching. We'd love to answer one of your questions in our next mailbag segment. Let's open up the Final Bar mailbag. Question number one, David, do you have any thoughts or analysis that looks at sectors relative to their monthly open versus monthly close? For example, XLK has only closed above its January open one day and failed. Net sellers for the month? Question mark. Great idea, and I love it. We'll look at the chart here, XLK. So you're basically saying, what about comparing where we're at versus the opening price for the month back here, and saying we only got above it, and then are coming off a little bit. Is there value there? So I guess the answer is yes and no. For me, it's less about the open versus the close, and I tell you why. If you're looking at a daily chart, the open versus the close is super meaningful because, in my opinion, because the open is a moment, right? 9:30 a.m. or depending on what asset class you're looking at, obviously that can be different, but a stock, 9:30 a.m. it opens. There is a gap between yesterday's close, even the aftermarket session, and the next morning. And so we've had a break. We now have a chance to digest overnight news, to digest macroeconomic indicators, geopolitical news, and then the stock opens. And so that opening has meaning because it is a particular event. The opening on a monthly chart, November 1st might be a Monday, it might be a Thursday, it might be a really important day, it might just be a day in the middle of the week. So the fact that a November 1st is a thing is less meaningful to me. Some days do have meaning. So like the first day of a new quarter, absolutely, because the last day of the previous quarter, people probably did some things, money managers to, window dressing, right? Sort of make their portfolio look potentially a certain way as you take a snapshot for clients, and then you're ready to put some riskier bets back on the first. So that's a thing. Year end, absolutely. Days open, absolutely. A monthly open, I am less of a big fan of. Weekly open, yes, because that shows you Monday morning as you sort of gotten over whatever happened this weekend. I would say though, instead of using that, what I would do is do a monthly candle chart. We don't look at them a lot on this show, only because to be honest with you, it's just we've got enough going on. But a monthly bar chart, a monthly candle chart, and looking how we've moved from the beginning of the month to the end of the month, and just using that as a way to understand a change of character, right? A series of positive candles, and I didn't make it a candle chart, so that's not super helpful yet. Let's make it a candle chart. A stretch of time where you have a series of up candles and you have a big down candle can tell you something about the change of dynamics, right? The big up candles from the March low and seeing this continued uptrend, and then the change that happened in September's candle, that tells you a little something that changed. Would I use that open as an important value? Other than that, I personally wouldn't. I've talked with other people that do things like that, but yeah, not my favorite thing to focus on. Any concern with obvious parabolic moves in the monthly weekly chart, which is a really good question. One of my guests this week, I think this was Joe Rabel, I want to say, right, showed a weekly chart of Freeport McMoran, and we're talking about this rise, and this is similar to the chart he was showing you. And if you depending on what time frame you look at it, a move can look more or less exaggerated based on what you're seeing. And so yes, the concern I have with plenty of things is the meteoric rise in a lot of these stocks, a lot of these groups. Same concern you have with something like Bitcoin when it goes from 20,000 to 40,000 in not that much time. It's certainly going vertical. The problem with when things go vertical is it's really accelerating. And I often early in my career was taught to avoid bubbles, to be afraid of them because they're going to burst. But what I learned later with institutional money managers are bubbles are fantastic because it means prices are going up a lot. Participate in that. It's all about just understanding the risk, making sure you manage that, and then just having a clear, defined set of rules on when you're going to exit a position, when that bubble, when that trend is no longer in place, or can you scale out of positions to lock in some profit. So yes, I think that's a concern with a number of stocks like this that have sort of accelerated to the upside. And one maybe that comes to mind just from this week would be GameStop on the daily chart, which is accelerating to the upsides. It's tough to chase a name like this on, today, given the acceleration that you've seen. So it's all about just understanding the trajectory. And again, go back to the simple stuff, higher highs, higher lows, it's still in an uptrend. Next question, would you say options and futures traders are the people who rely on technical analysis the most because of the short-term nature of their contracts? It's actually a really thoughtful question. And, it's worth noting that a lot of the technical indicators and technical analysis that we use was born in the futures market, in the commodities markets. So Wells Wilder, who designed pretty much most indicators that we kind of just assume have been around forever, like RSI, DMI, the ADX, parabolic studies, average true range. These are all things that Wells Wilder wrote about in the 1970s. It's a fantastic book that literally has his handwritten on accounting ledgers. He shows how he calculated these things by hand. I think it's called New Concepts in Technical Trading Systems or something kind of like that. A fantastic read just explaining how he was trying to understand the movements in commodities. So a lot of the stuff we use is born from there because there's a lot of volatility, which means a lot of opportunity. And it was a real struggle given the lack of fundamental data, right, of other information to drive short-term fluctuations in the price. You were left with the chart, left with the supply and demand. I would say with currency markets, you see the same thing. A lot of currency desks I went to, they weren't, they were following economic data and interest rates, but their main toolkit was charts, or were charts, because that's what would help you understand short-term supply and demand. So absolutely, I think you are onto something. And certainly if I was an options trader, which I am not, I would be using things like Bollinger Bands and volatility measures to understand increasing, decreasing volatility regimes, because I think that's the game. Next question, Dave, you had some technical troubles again today. We couldn't see the gold chart back to the year 2000. And I'm so sorry about that. I posted on our YouTube video yesterday. We saw we had a glitch where the screen froze. So I actually posted the link to the chart that I was showing at the time. Sorry for that. We're working on that. on what's happening when we're capturing the show. But if you missed anything, shoot me an email, thefinalbar@stockcharts.com. I'm happy to send you the link. And the person emailed me, I've already emailed it back to you. So you're welcome to anything that I show on the channel, of course. Final question here. It's my turn to share with you a chart. It circulated a bit on FinTwit yesterday. Let's see, it shows a projected upside left in this rally to 38.30 to 38.85. And thanks for creating this chart and sharing it with me. I haven't looked at this yet, but I brought it up here. Yeah, so what you're doing here is you're basically saying the run up from the March lows, we hit the peak in September. You're treating that as a consolidation pattern, lower highs, higher lows, and then the traditional, sort of approach of taking the height of that pattern, projecting it from the breakout level, which was there the second week in November. That gives us this upside objective pretty close to where we're at. With the red lines, you're actually indicating this narrowing, sort of this wedge of higher highs and higher lows, but it's sort of coming in. It's hitting a more consistent trend, less volatile trend. All of that suggests we're sort of in the latter stages of this uptrend. Absolutely. So as a contrarian, I see a lot of value in what you're doing, and it makes me want to think more risk off at this point. As a trend follower, I'm going to follow this regardless of how far it goes until the trend is proven otherwise. So, for me, this trend line that you've drawn here off the lows is one of the ones that we've shown. I think as long as we remain above that, it doesn't matter what our objective is, we're still in an uptrend. When that fails, and it could be here going into next week, absolutely could, we break down through that trend line support. I think that's going to have some meaning. Great chart, and thanks for sending that. And again, that idea of using the height of a pattern or the height of a base to project the upside is a well established approach. That's our mailbag. Thanks again for all of those questions. We need to wrap today's show and go to the 3 and 3 charts. 3 minutes. Here we go. Chart number 1 is the name exposure index. We also have the RIDEX flows, which are using the bullish versus bearish funds within the RIDEX family. The one I want to focus on is the name exposure index. Again, this is a National Association of Active Investment Managers. It's sort of like the AAII poll, but for active managers, more professional money managers, and they can actually go net. They can go leverage long. So it's 100% long, 200% long, 0%, 100% short, 200% short, I believe is how they describe it. And the question is, what is it? Or it might just be 0, 100, and 200. I'll have to look at that. But overall, you can go levered long, which is why it's above 100%. It's on 112, almost 113%. That is literally the second highest in history. If you go back to the beginning of this data back in 2005 or 2006, I want to say, this is literally the second highest reading ever. And the last time we got this high was toward the end of that bull run in 2017, about a month before the eventual peak. So it does suggest to me euphoric sentiment, tells me to be a little cautious as we see prices going higher. Having said that, what's going to move prices higher? The FanMag stocks have gone from not something you even care about because they're just a non-issue to all of a sudden being really important again. And you can see Apple, in my opinion, sort of this clear cup and handle pattern, which is a rounded base where you have a consistent resistance level and then a shorter, shallower pullback. You retest that level, you break out, which we arguably did today. If we get follow through going to the beginning of next week, that actually measures much higher. If you take the height of that pattern and measure it up, that's like 160 or so, I'm guessing, much further to the upside. So certainly suggesting to further strength. And this is after Google has already broken out. Netflix broke above its resistance after a triple top through the second half of 2020. So you're starting to see this real improvement in those stocks. And I could see the market, sort of relaxing a little bit while those stocks actually break out to the upside. Finally, railroads have been one of the better spaces. It's an infrastructure play. You've seen a lot of them go to new highs a couple of weeks ago, and now all of a sudden you're seeing them roll over. CSX is maybe one of the more concerning ones, breaking down through trendline support. And while it's not the end of the world yet, we're still above our last swing low, so you need to make a new low first. Overall, it's still okay, but weakness in that group would be a bit of concern. It would tell me a further rotation away from industrials, away from some of those sectors that have done well, back into the growth trade that we've been thinking about. Folks, that is our show, and that's a wrap for this week on the Final Bar. Thank you so much for joining us every weekday after the close. Get your questions to us anytime. The Final Bar at StockCharts.com. We'd love to hear from you. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.